One day after we covered NVIDIA's earnings, another chip company reported, and it's arguably just as central to the AI build-out story, even if it gets a fraction of the attention.
That's Marvell Technology, ticker MRVL. They beat on both revenue and earnings last night, and the stock still dropped over 7% after hours. We'll explain exactly why that happened, because it's a genuinely interesting story.
Welcome back to Order Flow, the show that breaks down the signals that actually move markets. Insider buying, institutional flow, and the milestones that separate story stocks from real businesses. I'm Matt.
And I'm Ryan. Standard disclaimer: this content is for informational and entertainment purposes only, not financial advice. The hosts may hold positions in the securities discussed now or in the future. Always do your own research and consult a licensed financial advisor before making investment decisions.
Quick primer: what does Marvell actually make? They're not building GPUs like NVIDIA. They're building custom AI chips for hyperscalers, plus the networking, optical, and memory technology that connects everything together inside a data center.
So think of it as one of the picks and shovels suppliers into the exact same AI infrastructure wave NVIDIA and Amazon are riding, just a different piece of the stack.
Now the numbers. Revenue was $2.739 billion, up 37% year-over-year, beating guidance. Non-GAAP earnings per share came in at 94 cents, also a beat.
Data center revenue alone was $2.17 billion, 79% of the entire company, up 46% year-over-year. Non-GAAP operating margin was 36.6%, up nicely both year-over-year and sequentially.
So genuinely strong numbers across the board. And yet the stock fell over 7% in after-hours trading, down to $224 from a regular session close of $241.
Here's why: the guidance for next quarter's gross margin actually came in a bit below what they just delivered. Management said it's because their custom silicon business is ramping fast, and that mix carries a less favorable margin near term. Investors focused on that, not the growth.
Management was clear it's temporary, not structural. They still expect operating margin to hit their 38 to 40% long-term target range by the fourth quarter of this fiscal year. But in a market that's rewarded AI names aggressively, that kind of near-term margin wrinkle can trigger a sharp reaction.
Now the real headline of the call: a massive expanded agreement with Google, disclosed in a filing just before earnings. Marvell issued Google a warrant for nearly 59 million shares.
And here's the structure. Most of those shares vest in 240 tranches, one tranche for every $500 million of custom product revenue Google buys from Marvell. Do the math on that, and it implies a cumulative framework of roughly $120 billion, running all the way out to fiscal year 2033.
CEO Matt Murphy was upfront that most of the near-term impact is already baked into next year's guidance. The real step-up lands in fiscal 2029 and beyond. They're saving the full breakdown for an investor day on October 6th in New York.
The deal covers a broad set of products that attach to Google's own AI chips: inference accelerators, storage controllers, network interface cards, memory controllers. Marvell calls this the XPU attach category, and they say they basically invented it as a distinct business line.
There's also a second major hyperscaler with its own custom chip program ramping with Marvell next year. Management wouldn't name them, but called it one of the company's largest long-term opportunities. Still early days.
Beyond custom silicon, there's a second big growth driver: scale-up optical networking, connecting chips together inside massive AI compute clusters. Management said that opportunity is now much larger than they thought just 1 quarter ago, and it's driving a $1.5 billion increase to next year's revenue guidance.
And there's a nice tie back to yesterday's NVIDIA episode. An analyst actually asked Marvell CEO directly about Jensen Huang's comments from the NVIDIA call on how compute, networking, and memory all need to work together as one fungible system. Murphy's answer was basically, that's exactly the layer of the stack Marvell lives in.
One more note on the balance sheet: total debt is just under $5 billion, but net debt relative to EBITDA is only 0.27 times. That's a very lightly leveraged company for how aggressively it's investing.
Now valuation. Marvell's market cap is around $211 billion. Stock's 52-week range is enormous, $61 all the way up to $330, which tells you how much this name has already moved.
Analyst sentiment is still very bullish. The vast majority rated a buy, average price target somewhere around $260 to $270, which implies real upside even after the post-earnings drop.
Alright, bull case. Point 1, broad-based accelerating growth. Revenue up 37%, data center up 46%, and full-year guidance raised for a second straight quarter.
Point 2, that Google warrant deal is a genuinely landmark commitment, with the biggest financial impact still ahead in fiscal 2029 and beyond, not even in current numbers yet.
Point 3, real operating leverage. Margins already at 36.6% and climbing toward the 38 to 40% long-term target.
Point 4, multiple independent growth engines, not just one customer. Custom silicon, scale-up optics, switching, memory expansion, and broadband analog are all contributing and all guided higher.
Point 5, the scale-up optics opportunity alone just got $1.5 billion guidance bump, a sign the addressable market keeps expanding, not just executing to plan.
Point 6, a very clean balance sheet, with net leverage under a third of a turn of EBITDA, giving real flexibility to keep investing and buying back stock at the same time.
Point 7, Marvell sits directly alongside NVIDIA's own AI build-out story without competing for the same dollars, capturing adjacent custom silicon and networking spend in the same CapEx wave.
And point 8, despite the drop, analyst targets still imply real upside, and there's a concrete catalyst just weeks away with the October Investor Day.
Okay, bear case, and there's real substance behind the sell-off.
Bear point 1, a beat-and-raise quarter still dropped the stock over 7%, purely on near-term margin mix. That tells you how high the bar has gotten for what counts as good enough.
Bear point 2, next quarter's gross margin guidance actually stepped down from what was just delivered. And while it's framed as temporary, it's a real, current headwind tied directly to the same custom silicon growth everyone's excited about.
Bear point 3, customer concentration is significant. The Google relationship is now central to the entire long-term story, and there's at least one other unnamed hyperscaler representing a similarly large future bet. Any pullback from either would matter a lot.
Bear point 4, the scale-up optics roadmap requires betting across multiple competing, unproven technical standards at once. Nobody knows yet which packaging and modulator technologies customers will actually standardize on.
Bear point 5, a lot of the true scale of the Google deal is being saved for the October Investor Day rather than quantified today. Investors are being asked to trust a monster number without full visibility yet.
Bear point 6, that 52-week range from $61 to $330 shows just how sharply this stock can re-rate in either direction on sentiment alone, not just fundamentals.
Bear point 7, operating expense guidance was also raised this quarter, a reminder that capturing this opportunity requires continuously rising investment, not free operating leverage.
And bear point 8, this call featured a brand new CFO on his very first earnings call, plus a separate investor relations leadership transition, right as the company navigates its most complex customer agreement yet. That's real key person and continuity risk at a pivotal moment.
So the tension is pretty clear. Genuinely excellent, broad-based growth and a landmark customer commitment, sitting right next to near-term margin pressure and a market that's demanding perfection after an enormous run.
Exactly, milestone tracker, how do we track this one?
Milestone 1, the Investor Day on October 6th in New York, where management promises a full-ranged breakdown of the custom silicon opportunity through the end of the decade.
Milestone 2, third quarter earnings, guided to $3.15 billion in revenue and 57.5 to 58.5% non-GAAP gross margin. Watch whether that margin step-down plays out exactly as guided.
Milestone 3, any further disclosure on that second, unnamed hyperscaler's custom chip program.
Milestone 4, whether operating margin actually enters that 38 to 40% target range in the fourth quarter, as promised.
Milestone 5, the real-world pace of Google warrant vesting. since each tranche ties directly to $500 million of actual custom product revenue.
Milestone 6. The signs of customer standardization on the competing scale-up optical technologies Marvell is investing across.
And Milestone 7. Continuity through both the new CFO and the incoming investor relations lead.
That's Marvell, the quieter half of the AI infrastructure story we started with NVIDIA yesterday, with a landmark Google deal that's barely begun to show up in the numbers yet.
We'll check back in as the next milestones hit. That's order flow. Follow us wherever you're listening, and we'll see you in the next one.